We are in a crisis. You know it. I know it. Your neighbor knows it. Everyone knows it. Oil tankers are getting attacked in the Persian Gulf. The crisis seems to be getting worse. Central banks are buying gold like crazy. National debt just blew past whatever insane $1 trillion amount it is right now. And here's the question nobody on financial TV has the guts to answer. Why hasn't your gold gone up? I mean, seriously, you bought the gold. You did what the smart money said. You watched the chaos. You followed the playbook and your gold stack, your gold ETF, it's down right. So if that's, you stay right here because what I'm about to show you in the next few minutes is going to change the way you see gold, silver, and every crisis investment for the rest of your investing life. My name is Ali, and I sat on trading floors. I've watched how the markets work, and I've seen this pattern play out gold dropping in the middle of a crisis, and what I'm about to walk you through is not an opinion. It is a mechanical sequence that has repeated after every major oil shock in the last 50 years 1973, 1979, 1991, 2001, 2022, every single time, and once you see it, you can't unsee it. So let's start with the thing that's making your blood boil and making you lose sleep. If you have a crisis, what does gold do? What does gold do after and before and during? Well, gold drops during. And that doesn't sound very logical, but I can tell you that's what happens every single time. Not after, not before, but during. And I know that sounds mad. Gold is supposed to be the safe haven, the thing you run to when the world's on fire. It's your financial shelter, right? But here's what the greatest traders understand. Something most regular investors don't. Gold doesn't respond to fear. Gold responds to what Wall Street calls liquidity. And in the first few weeks of any major shock, liquidity does something very specific, something very predictable, and something very painful if you don't understand it. So here's the mechanical sequence. Write this down, take a screenshot, whatever you need to do to remember this. We get a big event. Let's say, hypothetically, a major war in the Middle East. What happens next? Well, oil goes up, right? What happens when oil spikes? Well, actual inflation doesn't go up immediately, but inflation expectations certainly do. When inflation expectations rise, what does the Federal Reserve do? The Fed can't cut rates. Now, when the Fed can't cut rates, what happens? And I know this gets a bit complicated, but bear with me. Seriously, this is so important. Bond yields. So basically, debt interests go up, right? When bond yields are high, gold becomes less attractive. Why the heck is that the case? It sounds so unfair. Well, if you have debt, government, US debt, guaranteed by the government, and then you have gold or any other asset, well, then debt sounds more appealing right now because it's paying you a higher interest. So if you can get 5% from the US government with zero risk, and then gold is there doing nothing, money is going to flow into the sure thing. And there is one more thing to this, and I told you this was going to be a little bit complex, but it's so important. The other thing that happens here is that the US dollar goes up. And we've seen that. Why? Because all the scared investors around the world who are terrified about said event, you know, the hypothetical war in the Middle East, they're going to move their money into the one safe haven that the world still seems to believe in. And what is that? It is US debt. So money pours into here and therefore the dollar goes up. Are you still with me so far? Is this landing for you so you have, in essence, higher US bond yield, which is just a fancy word for how much money you can make off bonds? You get a stronger US dollar, which again makes the bonds more attractive because if you buy them, say you're a foreign investor, you deal in euros, you now buy your US dollar bond, you get a higher interest rate, and then the US dollar goes up. So you are like twice as happy, right? On top of that, we know that the Fed is basically stuck. They can't do anything. They can't really cut rates anymore. So you get three headwinds hitting gold at the exact same time. And that is why your gold is down while the world burns. This is probably the first time someone's explained this to you properly. Now here's where this gets exciting because this suppression, this mechanical, predictable, temporary suppression of the gold price It does not last. Here's what happens next. The bond traders, who are definitely smarter than most of us, they're realizing that the US has some crazy amount of debt, whatever it is right now, 38 trillion. And they also know that about 9 trillion of that needs to get refinanced, which is just an extra $1 trillion in interest payments. The government now pays more in interest than it spends on its entire military. And that's pretty mad, right? The entire Pentagon budget, like every aircraft carrier, every fighter jet, every soldier, more spent on debt. So the bond market looks at this and they go, the only way this is sustainable is if we get lower interest rates. And they therefore know that the Fed has to cut rates because the US can't afford not to. And that's going to be the reversal trigger. When the bond market understands that rates must come down, the thing I just showed you will start to unwind. The dollar will weaken again, and every single one of those three headwinds I just described will disappear. And in my opinion, gold will once again go up. By the way, the same is true for silver. Let me show you every major oil shock in the last 50 years, and I'll show you what gold did, because this will make you believe it, and this will make you understand it, and this will therefore allow you to make a better decision going forward. So, if you go back to October 1973, I was minus 7 years old at the time. OPEC cuts oil production and then slaps an embargo on the US, right? And oil goes from $3 to $12. It goes up 4 times. Now, what does gold do? Gold initially went down and then it rallied 150% in 2 years. And if you look at the entire time period, 1971 to 1980, which is kind of the whole oil inflation disaster, gold went up 2,300%. Not a typo, 2,300%. And let me know in the comments if you think we're going to do a repeat. But let's go back and look at a completely different part of the world, a completely different crisis, 1979, the Iranian Revolution, the Shah falls, and we won't mention that certain countries armed the Ayatollah and might at present be fighting the very same forces. Anyway, we don't need to go into that either. That is not popular either. But it's true, isn't it? We just keep going around and around in cycles, which is very profitable for some people. Anyway, what happens? Well, oil production drops, right? So oil production drops massively because actually the Iranians at the time made a lot of oil. So what happens next? The price of oil goes to the moon. And what happens to gold? Well, doesn't do a lot initially. And then over the next 12 months, it goes up 89%. And then over the following year, it does another 10 something percent. So it goes up big after this oil crisis. Now, what if there was another oil crisis in some other part of the world, say 1991, the Gulf War? Oh, yes, we're back in the same part of the world again, aren't we? Yes, another country that we once armed to fight the Iranians. Anyway, so Iraq invades Kuwait, oil spikes a lot, gold actually popped up fairly quickly. Gold popped up about 10%. In a couple of weeks, energy stocks went up a lot. Defense stocks obviously outperformed till the end of time. But gold certainly popped here, 2001. The post 9/11 world markets crash. Everybody panics, and then the recovery pattern kicks in. Gold began a decade-long bull run from literally $250. That's how cheap it was, to $1,900. That is an epic bull run, right? And then, oh no, actually, there's another part of the world apparently. 2022, Ukraine, Russia. What happens? Gold goes up, right? Gold breaks through $2,000 and a bit. I think that was gold, and look what every single one of these major gold rallies had. Fewer structural events supporting the price of precious metals than we're seeing right now. In 73, the US national debt was like $500 billion, right? Today it's what, 38 trillion or something? In 73 central banks were selling gold, and they're not, I can tell you, we track it. First of all, we track if institutions are selling. By the way, this is something in our community which you can join. We make data available very affordably. You can also keep an eye on what's going on in the world, by the way, which is pretty useful, especially if you're into mining and everything else, because You can see all the energy infrastructure in the world, you can see all the mines in the world, and you can really see what's going on there. But if you go back to the metal side here, yes, institutions are selling, that's useful to know, but when they're selling at this extreme level, right, this is pretty extreme, right? They're really, really selling, and you look at what happened in the next 90 days, and it's not financial advice. I'm not a registered financial advisor, but historically doesn't mean it's going to happen again. It went up 20% over the next 90 days when the institutions were this heavily positioned against gold as they are right now, right? Silver, similar story, not quite as extreme right now, but I'm still, I must admit, bullish on silver. Doesn't mean I don't think silver is going to go on another run. What I was trying to make the point is that central banks are buying, right, over 1,000 tons last year, which is just massive, massive buying. So central banks are diversifying away from the US dollar because they know what can happen. They can seize your money, Imro, right? So they don't trust the dollar. And if you go back to, say, 1973, there was no silver supply deficit either. They didn't have one. In 73 didn't have one, but in 2026 we have one for 3 years running. So the fundamental story hasn't really changed. China is restricting more and more exports, so every condition is more extreme. So now you understand why gold drops first. You've seen that it recovers every time. Doesn't mean it has to this time. But we're looking at history here, so the $1,000,000 question is literally when. Tell me when. I've got patience. I've been in gold for 3 days. I haven't made any money, right? Yeah, patience is a virtue, they say. When does the recovery in gold and silver prices happen? We saw a little bit of a bounce in the last few days, but not significant. And when do we get in? When do we get out? So this is what I learned from my Wall Street mentors, guys who literally worked in banking and metal exchanges for decades. And it is the 4-phase recovery pattern. There are 4 phases to this. Phase number 1, and that is usually week 1 to 4. And what happens? Everybody panic sells, right? Oil and gold, everybody panic sells, markets drop. Financial media is running 24/7 coverage with dramatic music and red graphics to really freak you out. And this is where most regular investors do one of 2 things. Either they panic sell or they panic buy gold at the absolute top of the war spike, right? Both are typically wrong. So what's actually happening? Smart money, well, they think they're the smart money. Just ask them. Institutions, pension funds, sovereign wealth funds, and so on. They're watching, they're patient, they've seen the movie before, right? They're not doing anything. And then we get into phase 2, which is usually month 2 to 3. The panic in the market starts to settle a little bit. There's an indicator called the VIX, which is fear that comes down a little bit, and the safe havens pull back. Gold drops, right? Silver will drop more, maybe 15, maybe 20%. And that's kind of where the massacre happens, because this is where the average investor looks at their portfolio, sees red and says, read something about gold being over, and sells right. And in my opinion, this is the worst possible time to sell, but it is the most common time that people do sell because we as humans are hardwired to do the wrong thing at exactly the wrong time. And then we get to phase number 3, and that's usually month 4 to 18. This is where the money is made. The broad market starts recovering. Rotation into growth starts beginning. Gold finds support again. Not the panic support, but the structural support backed by central banks buying. The supply deficits in silver and all the debt stuff that we talked about, miners start going up, energy stocks rally. And here's the really cruel part. Most regular investors are too scared to get back in. They sold in phase 2, they took a loss, and now they're sitting on the sidelines watching, and they're going, I'll wait for the pullback. I know it's going up, but it's temporary. I don't trust it. I'm going to wait for the pullback. The pullback may never come. And that leads us into phase 4. This is typically month 12 onwards. Can be even 2 or 3 years. Is this time period, what do we get? we get new all-time highs, higher than the pre-crisis level. And this has happened literally after every major oil shock in modern history: 79, 1991, 9/11, 2022, new highs. Now, do you want to be positioned before the crowd figures this out? I'm going to talk to you about more than just gold and silver here. Let's look at the 5 sectors that have outperformed during every single geopolitical crisis over the last 50 years. So, what are our sectors? Sector number 1, we have gold and gold miners, right? Ticker symbols like GLD, GDX is the miner ETF. You can, of course, also buy the physical right. There is an advantage in that. You own it. No shenanigans of Wall Street are involved, but there's a premium you pay. You've got some storage issues. You've got some insurance issues. You've got to sort that out. I have a friend who says, I have 12 very large dogs and a shotgun. I think I'm fine. That works in some parts of the world. It is unfortunately illegal in others. But why are we looking at miners? Because, say, gold goes up 10%. The miners tend to go up 20 to 30%. We made a lot of money last year on the miners. We're very happy with that. So it's a leverage bet on the gold price without the complexity of actually setting up leverage, which I'm usually not a big fan of. Now, the second sector we're looking at is silver, right? You could just buy an ETF, SLV, if you must. We've talked extensively about the shenanigans of the silver market. I'm not going to get into that here, but I want to spend a little bit of time on it because most people misunderstand silver. Silver isn't just a precious metal. Gold is precious, right? It's the precious metal. It's a monetary metal. Silver is also a precious metal, but it is also an industrial metal. What does that mean? It goes into solar panels, electric vehicles, AI data centers, defense electronics. And the opportunity is that, depending on which side of the trade you're on, silver has been in deficit for years. So the world is literally consuming more silver for years than it's producing, and you don't need a degree to know what happens when demand exceeds supply for years, right? Inventory drops, you can look at the exchange industry inventory. We're at about 76 million ounces. We were at about 120 million, right? So we're looking at half that. So there isn't a lot left there. And the largest refiner of silver has restricted exports. We have the silver stress index at extreme at 95. And why am I telling you this? Because if we go back and we look at how gold performed and how silver performed, silver outperformed gold by a factor of 3 times. Again, I'm not saying it's therefore going to happen this time guaranteed, but this is the history, right? So if silver does a fraction of what it did in 79, and we adjust for the current structural deficit and the massive industrial demand we didn't have then, we didn't have solar panels, right? It potentially could be more or less right. And then we have sector number 3, which is energy. Now, a simple way to invest in the energy sector is you buy an ETF called XL. Of the world's oil goes through the Strait of Hormuz. That is disrupted. So oil prices are going up, and XLE gives you broad exposure to the whole sector. It's not rocket science. 4 is defense, and they tag on aerospace to make it sound a little bit better. They're basically war stocks. The biggest ETF on this one is called ITA. In defense, spending isn't going to go down, right? It's going to go up. Like after 9/11, defense stocks outperformed the S&P by 47%. And ITA aerospace and defense gives you the whole basket. It's already up. Again, I'm not saying you should run and buy it. I'm just saying those sectors tend to typically continue to outperform. And then we've got sector number 5, which is the really impressive stuff, utilities. And the ticker symbol here is XLU if you want the broadest one. Why utilities? Well, they pay dividends, they are domestic, they're defensive. So every major market crash was preceded by an oil price spike. Literally go back 1999, 2007, 2021. And by the way, one of my mentors told me this 2 days ago. I shouldn't take the credit for it, and he's right. And if the S&P, so if you're worried about a market crash, then look at this. Say 2022, the S&P went down. We went down 15% on the S&P after Russia invades Ukraine. What about utilities? Utilities were flat, which is a lot better than minus 15%. Everything is bleeding. But the boring stocks that did their job right. So a smart portfolio for a geopolitical shock isn't 100% gold. It is diversified across sectors based on your risk tolerance. The real game isn't panic. It's pattern recognition. While most investors chase hype, smart money quietly accumulates during fear. Short-term dips in gold aren't weakness. They're part of a bigger cycle. With rising debt, money printing, and inflation ahead, hard assets are setting up strong. The question isn't what the market is doing. It's what kind of investor you choose to be. Type 1 reacts. Type 2 prepares. Thanks for watching Fiscoria.